people think I have lost my mind. They see mortgage rates hovering near 7% and wonder why anyone would buy property right now. They see home prices at record highs and conclude that waiting for rates to drop is the only sensible strategy. They read the headlines about declining affordability and assume that real estate has become a trap for the unwary. But I am doing exactly the opposite of what most people expect. I am buying real estate while interest rates remain elevated, and I am doing it for reasons that most people completely misunderstand. Let me explain why I believe this moment represents one of the most significant real estate opportunities I have seen in decades. The first thing you need to understand is that most people have the relationship between interest rates and real estate completely backwards. They think high rates are bad for buyers and low rates are good. On the surface, that seems logical. Higher rates mean higher monthly payments, which makes homes less affordable. Lower rates mean lower payments, which makes homes more accessible. But that simple logic ignores something crucial. It ignores how human behavior responds to interest rate changes. When rates are low, everyone wants to buy. Competition intensifies. Bidding wars break out. Sellers gain enormous leverage. Prices get pushed to irrational levels. And buyers who win those bidding wars often pay far more than the intrinsic value of the property. When rates are high, the opposite happens. Many potential buyers retreat to the sidelines. Competition decreases. Sellers lose their leverage. Negotiating power shifts to buyers, and those who have the courage to act can often acquire properties at meaningful discounts to what they would pay in a frenzy. I learned this lesson decades ago, and it has informed my approach to real estate ever since. Back in 2012, I told CNBC that if I had a way to buy a couple 100,000 single-family homes and manage them efficiently, I would load up on them. That was in the aftermath of the financial crisis, when home prices had collapsed and most Americans were terrified of real estate. Rates were low, around 3.5%, and prices were depressed because fear dominated the market. The median home price in 2012 was around $180,000. Today, that same median home is worth over $400,000. Those who bought then and held have seen their investment more than double on top of all the rental income they collected along the way. The lesson is not that you should only buy when rates are low. The lesson is that you should buy when fear dominates and prices reflect that fear. Sometimes that coincides with low rates, as it did after the financial crisis. Sometimes it coincides with high rates, as it does today. Right now, fear is keeping many buyers on the sidelines. Pending home sales have been hovering near multi-decade lows. Traffic through real estate offices remains subdued. The number of active buyers in the market has dropped from over 2.5 million in 2015 to under 1.5 million today. That fear creates opportunity for those who can see beyond the current moment. Now, let me share something that most financial commentators consistently get wrong about real estate and interest rates. The 30-year fixed-rate mortgage is one of the most remarkable financial instruments ever created. It offers benefits that no other major investment vehicle provides. When you take out a 30-year mortgage, you are essentially betting against the lender. If rates go up after you lock in, you keep your lower rate for 3 decades. The lender is stuck with a below-market loan. But if rates go down, you simply refinance into the lower rate. The lender loses again. It is a one-way negotiation where the homeowner holds all the cards. I have called the 30-year mortgage a terrific deal for exactly this reason. You date the rate, but you marry the house. The property is permanent. The financing is temporary. Think about what this means in practical terms. If you buy a house today at 7% and rates drop to 5% in 3 years, you can refinance and capture those savings. Your monthly payment goes down, and you benefit from whatever appreciation occurred in the meantime. You get to have your cake and eat it too. But if you wait for rates to drop before buying, you face a different set of risks entirely. Home prices might rise while you wait, offsetting any rate savings. Competition might intensify when rates drop, forcing you into bidding wars. The specific property you wanted might sell to someone else, and you will have spent those years paying rent instead of building equity. The math often favors buying now and refinancing later over waiting for perfect conditions that may never arrive. Let me tell you about 2 real estate investments I made. decades ago that illustrate my thinking about property. In 1986, I purchased a 400-acre farm about 50 miles north of Omaha from the FDIC. The farm bubble of the early 1980s had just burst. Prices had collapsed by 50% or more. Banks throughout Iowa and Nebraska were failing at 5 times the rate we saw during the Great Recession. Fear was everywhere. I paid $280,000 for that farm, considerably less than what a failed bank had lent against it just a few years earlier. Now, here's the interesting part. I knew absolutely nothing about operating a farm. I could not tell you the difference between a bushel of corn and a bushel of soybeans. My daughter Susie once joked that I could not even find the light switch in my own house. But I did not need to be an expert farmer. I just needed to understand the basic economics. My son Howard loves farming, and he taught me how many bushels of corn and soybeans the land would produce each year. He told me what the operating expenses would be. From those simple estimates, I calculated that the normalized return on my investment would be about 10%. I also recognized that productivity would likely improve over time as farming technology advanced, and I believed crop prices would trend higher over the long term due to population growth and increasing global demand for food. Both expectations proved correct. That farm has generated solid returns for nearly 40 years now. The income has grown, the land value has appreciated, and I still know almost nothing about the actual mechanics of farming. The point is that real estate investing does not require expertise in property management. It requires expertise in value assessment. You need to understand what an asset will produce and what you are paying for that production capacity. Everything else is secondary. I made a similar investment in 1993 when I purchased retail property near New York University. The real estate recession of the early 1990s had crushed commercial property values. Fear dominated the market. A Resolution Trust Corporation liquidation sale offered the opportunity I was looking for. My friend Fred Rose told me about the property. He knew the area and understood that NYU would keep expanding and students would keep needing places to shop and eat. I bought in at a capitalization rate that seemed attractive given the location and the tenant base. That property has also delivered excellent returns over 3 decades. The income has grown, the value has appreciated, and most importantly, the investment validated the same principles that guided my farm purchase. What the economy, interest rates, or the stock market might do in the years immediately following 1986 and 1993 was of no importance to me. I cannot remember what the headlines or pundits were saying at those times. Whatever the chatter, corn would keep growing in Nebraska and students would keep flocking to NYU. Both investments succeeded because I focused on intrinsic value rather than market timing. Now let me explain what I see in today's real estate market that makes me optimistic despite the challenges. The United States faces a structural housing shortage that will take years or even decades to resolve. Various estimates put the deficit between 2 million and 5 million homes. Some organizations calculate even higher shortfalls. The exact number matters less than the direction. We are dramatically undersupplied, and that undersupply is not going away quickly. After the Great Recession, home construction collapsed and never fully recovered. For over a decade, builders produced fewer homes than population growth and household formation demanded. The pandemic briefly boosted construction, but we are still running below historical averages. This shortage creates a floor under home prices that many observers underestimate. Even as higher rates reduce demand, constrained supply prevents the price collapses that some bears predict. The inventory of homes for sale remains near historic lows. Months of supply in most markets suggest a balanced or seller-friendly environment despite reduced transaction volumes.
Goldman Sachs estimates that we need 3 to 4 million additional homes beyond normal construction just to restore affordability to reasonable levels. At current building rates, that could take a decade or more.
Throughout that period, the fundamental supply-demand imbalance supports property values. This is not a bubble situation. Bubbles occur when prices detach from fundamentals due to speculation and easy credit. What we have today is a supply crisis driven by decades of underbuilding, restrictive zoning, and skilled labor shortages in construction. Those are structural problems that take years to solve. Meanwhile, demographic tailwinds continue. Millennials, the largest generation in American history, are entering their prime home buying years. They were delayed by the financial crisis and student debt, but they are not going away.
Many have started families and need more space than apartments provide. That demand will persist regardless of where interest rates go.
So when I look at real estate today, I see temporary headwinds from high rates, but permanent tailwinds from supply constraints and demographics. The temporary headwinds are keeping many buyers away, creating opportunities for those willing to act. Let me also address the home builders, because Berkshire Hathaway has been actively investing in this sector. In 2025, we built significant positions in Lennar and D.R. Horton, two of the largest home builders in America. These investments totaled nearly $1 billion and sent a clear signal about our view of the housing market. Why would we invest in home builders when housing affordability is so challenged and rates remain elevated? Because we believe the structural housing shortage will drive demand for new construction for years to come. The existing home market is frozen by the lock, in effect. Homeowners sitting on 3 and 4% mortgages are reluctant to sell and take on 6 or 7% loans for their next purchase. That restricts supply of existing homes and pushes more demand toward new construction. Builders can offer what existing home sellers cannot: mortgage rate buydowns, fresh warranties, modern floor plans, energy-efficient construction, no competition from multiple offers. Buyers who cannot find suitable existing homes increasingly turn to new builds. Yes, builders face challenges. Gross margins have compressed as they offer incentives to move inventory. Some markets have excess supply of completed homes. Labor costs keep rising, but the fundamental demand driver, the housing shortage, remains intact. We like Lennar in particular because of its land optionality and disciplined approach to the current environment. The company understands that this cycle requires flexibility and efficiency. It is not overreaching on land purchases or building speculatively into weak demand. It is meeting the market where it is while positioning for recovery. These home builder investments complement our long-standing ownership of Clayton Homes, one of the largest manufactured housing producers in the country. Clayton builds affordable homes for Americans who cannot access traditional site-built housing. Together, these positions give Berkshire meaningful exposure to housing demand across multiple price points and construction methods. Now I want to talk directly to the individual investor or family considering a real estate purchase in this environment. The most important question is not what interest rates will do. The most important question is whether you have found a property you want to own for the next decade or longer. If you are planning to stay in a home for 5 to 10 years minimum, buying now at higher rates is far less risky than it might seem. Over that holding period, you will likely refinance at least once if rates decline. You will build equity through principal paydown even if prices stay flat. You will lock in your housing costs while rents continue rising. And you will benefit from the long-term appreciation that has characterized American real estate for generations. The risks of buying now are relatively contained if you can afford the payments. The worst-case scenario is that rates stay high for longer than expected, but you are still building equity and locking in your housing cost. You are not losing money, you are just earning a lower return than you might have with better timing. The risks of waiting are harder to quantify. Home prices could rise while you wait, especially given the supply shortage. The specific properties you want could sell to others. Rent payments will continue with no equity accumulation. And if rates drop sharply, competition could intensify faster than you can act. I am not saying everyone should rush out and buy property tomorrow. I am saying that the decision should be based on your personal situation and long-term plans, not on predictions about where rates are heading. If you can afford the payment at today's rates and you plan to stay for a decade, buying now is probably sensible. If rates drop, refinance. If they stay high, you locked in a payment you can handle. Either way, you own an asset that has historically appreciated over long holding periods. Let me share some specific advice for those considering real estate purchases in this environment. First, do not stretch beyond your means, hoping that refinancing will bail you out. The worst financial mistake is buying a home you cannot comfortably afford at current rates. If your budget depends on rates dropping within a year or two, you are speculating, not investing. rates could stay elevated for longer than anyone expects. Buy what you can afford now and treat any future refinance as a bonus rather than a requirement. Second, focus on location and quality over timing. The specific property you choose matters far more than whether you bought in a high-rate or low-rate environment. A great property in a desirable location will appreciate regardless of rate fluctuations. A mediocre property in a declining area will struggle regardless of your financing terms. Spend your energy finding the right property rather than trying to time the market perfectly. Third, consider the full picture of housing costs. Mortgage payments are just one component. Property taxes, insurance, maintenance, and utilities all affect your total cost of ownership. In many markets, renting has become more expensive than owning when you account for equity accumulation and tax benefits. Run the complete numbers for your situation rather than fixating solely on mortgage rates. Fourth, remember that you are dating the rate but marrying the house. The financing is temporary. The property is permanent. If you find a home you love in a location that meets your needs, the rate environment becomes secondary. You can always change your mortgage. You cannot always find the perfect property. Fifth, work with professionals who understand local conditions. Real estate is inherently local. National statistics and commentary may not reflect what is happening in your specific market. A good real estate agent and a knowledgeable lender can help you navigate opportunities and pitfalls that national commentators miss. I also want to address the rental investment side of real estate because many people wonder whether landlording makes sense in this environment. The fundamentals for rental properties remain strong. Rents have been rising as affordability challenges push more households into renting rather than buying. The apartment vacancy rate remains low historically, and the single-family rental sector has grown substantially as institutional investors recognize the opportunity. If you are handy and willing to do the work of property management, buying rental properties at today's prices and rates can still generate attractive returns. The key is buying at prices where the rental income covers your costs with some margin left over. That margin provides cushion against vacancies, repairs, and rate fluctuations. I have said before that if I were a handy person who could manage properties efficiently, I would buy distressed homes and rent them out. That advice remains valid. The work is substantial. Managing tenants, handling repairs, dealing with local regulations. But for those willing to put in the effort, rental real estate can provide income, appreciation, and significant tax benefits. The challenge at scale is management. When I said I would load up on hundreds of thousands of homes if I could manage them efficiently, I was acknowledging the fundamental limitation. Real estate is not like stocks. You cannot buy $1 million worth of homes as easily as you can buy $1 million worth of equities. The property-by-property nature of real estate investing creates friction that scales poorly. That is why real estate investment trusts exist and why we have invested in some REITs at Berkshire. They provide real estate exposure with stock-like liquidity and professional management. For investors who want real estate in their portfolio but cannot or will not manage properties directly, REITs offer a sensible alternative. Our recent investment in Lamar Advertising is one example. Lamar is structured as a REIT focused on outdoor advertising real estate. We acquired over 1 million shares worth approximately $142 million. The investment provides exposure to a specialized real estate niche without the management complexity of owning properties directly. For the average investor, a mix of approaches often makes sense. Own your primary residence to lock in housing costs and build equity. Consider rental properties if you have the skills and inclination for hands-on management. Add REIT exposure for diversified real estate allocation without direct ownership headaches. The important thing is not to avoid real estate just because rates are high. The important thing is to invest in real estate intelligently based on your capabilities and objectives. Let me step back and share some broader perspective on why real estate deserves a place in most investment portfolios. Real estate provides something that stocks cannot: utility value. You can live in a house, you cannot live in a share of Apple stock. That utility value creates a floor under real estate prices that purely financial assets lack. People need shelter regardless of what markets do. Real estate also provides inflation protection in a way that many assets do not. When inflation rises, rents tend to rise along with it. Property values tend to increase as replacement costs climb. The same dollar of real estate buys more protection against purchasing power erosion than the same dollar in many other assets. Over long periods, real estate has delivered solid returns while providing stability and income. It is not as exciting as high-flying growth stocks. It will not double in a year like a hot technology company might. But it also will not fall 80% in a downturn like some stocks do. That stability has real value in a portfolio context. My primary residence is still the house in Omaha that I bought in 1958 for $31,500. That property is now worth over $1 million according to current estimates. More importantly, it has provided my family with shelter and stability for nearly 7 decades. That utility value cannot be measured in dollars alone. I share this not to brag, but to illustrate a point. Home ownership works over long time horizons. The specific timing of your purchase matters far less than whether you hold for decades. Buy a good property in a good location at a price you can afford, and time will take care of the rest. Now let me address some common objections I hear about buying real estate in the current environment. Some say we should wait for a crash. They point to high prices and stretched affordability and predict a major correction. But crashes require a catalyst that overwhelms demand. The supply shortage provides a fundamental support that makes crashes unlikely. Prices might flatten or dip modestly in some markets. A 50% crash like 2008 seems improbable given current conditions. Some say we should wait for rates to drop, but as I explained, when rates drop, demand surges and competition intensifies. You might save money on financing while losing money on purchase price and negotiating leverage. The net effect could easily be negative. Some say real estate is overvalued relative to incomes. That is true in many markets. But incomes are rising and supply remains constrained. Overvaluation relative to current incomes does not mean prices must fall. It might mean prices stagnate while incomes catch up. For a buyer with a long time horizon, stagnation is very different from collapse. Some say homebuilder stocks are a better way to play housing than actual properties. That can be true for investors who want market exposure without property management. But homebuilder stocks carry their own risks: margin compression, land cost inflation, interest rate sensitivity. Actual properties provide income and utility that stocks cannot match. The common thread in these objections is an assumption that timing the market is possible and worthwhile. I do not believe that. Over my career, the biggest profits have come from buying good assets at reasonable prices and holding them for a long time. Trying to time market tops and bottoms has destroyed more wealth than it has created. Real estate rewards patience and discipline, not timing and prediction. Before I conclude, let me share one more story that captures my philosophy on real estate investing. In 2017, I told CNBC that the 30-year mortgage is an incredibly attractive instrument for the homeowner. You have a one-way bet. If rates go down, you refinance and pay off the home early. If they go up, the other guy is stuck with it for 30 years. That asymmetry is extraordinary when you think about it. In almost every other financial transaction, both parties take on roughly equal risk. If you buy a stock, it can go up or down equally from your perspective. If you lend money, you might receive more or less than expected based on interest rate movements and credit events. But the 30-year mortgage tilts heavily in the borrower's favor. The lender takes on the risk of falling rates without any offsetting benefit if rates rise. The borrower can always refinance into improvement, but is never forced to, except deterioration. This asymmetry is why I encourage people to use 30-year mortgages even when shorter terms might offer slightly lower rates. The option value of being able to refinance is worth far more than the modest rate differential. And it is why I am comfortable buying real estate when rates are high. High rates create the opportunity for future improvement through refinancing. Low rates leave no room for financing gains and often coincide with inflated purchase prices due to increased competition. The current environment offers that optionality in spades. Buy today at 7% and you have substantial room for improvement if rates moderate over the coming years. Lock in a good property at a negotiated price while competition remains muted and refinance when conditions improve. That is a much better position than buying at 3% in 2021 when prices were inflated, competition was fierce, and rates could only go one direction. As I approach the end of my career, I find myself more convinced than ever that real estate belongs in most investment portfolios. Not as a get-rich-quick scheme, not as a way to time markets or predict rate movements, but as a long-term holding that provides utility, income, inflation protection, and appreciation over decades. The current environment of high rates and muted competition creates opportunities that will not last forever. When rates eventually decline, buyers will flood back into the market. Prices will adjust upward. The negotiating leverage that buyers enjoy today will evaporate. Those who act now, who buy good properties at reasonable prices and lock in fixed-rate financing, will look smart in retrospect. Those who wait for perfect conditions will find that perfect conditions never arrive, or that they arrive at prices that eliminate the opportunity. I am buying real estate while interest rates are still high. I am investing in home builders who will benefit from the structural housing shortage. I am positioning Berkshire Hathaway for the next cycle of real estate prosperity that I believe is coming. You may not be able to buy hundreds of thousands of homes like I once fantasized about, but you can buy one. You can acquire a property that will shelter your family, build your wealth, and provide stability for decades. The rates you lock in today are temporary. The property you acquire is permanent. Marry the house, date the rate, and trust that time will reward your patience. That is my message to anyone considering real estate in this environment. The opportunity is real. The math supports action rather than waiting. And the long-term trajectory of American real estate remains upward, as it has for my entire lifetime. Be greedy when others are fearful. Right now, many buyers are fearful of high rates. That fear is your opportunity. Take it. Let me now dig deeper into some aspects of real estate investing that I believe most people misunderstand. The first is the concept of forced appreciation versus passive appreciation. When you buy stocks, your returns depend entirely on forces outside your control. The company's management makes decisions. The market assigns a valuation. You sit back and hope for the best. Real estate is different. Yes, there is passive appreciation driven by market forces, but there's also forced appreciation that you control. You can improve the property. You can increase rents. You can reduce operating expenses. You can change the use to something more valuable. This control over destiny appeals to me greatly. I prefer investments where my actions can influence the outcome rather than those where I'm entirely at the mercy of external forces. When I bought that Nebraska farm in 1986, I could not control corn prices or weather patterns, but I could control the quality of the tenant farmer I selected, the capital improvements we made over time, and how efficiently we managed operating expenses. Those controllable factors contributed significantly to our returns over the decades. The same applies to residential real estate. A homeowner who maintains their property well, makes strategic improvements, and builds strong relationships with neighbors and community will generally see better appreciation than one who neglects these factors. The investment is not entirely passive, and the returns reflect that. This is another reason why I believe buying during high-rate environments makes sense. When competition is muted, buyers can often acquire properties that need some work at meaningful discounts. They can then add value through improvements that would have been bid up by other buyers in more competitive environments. The combination of a better purchase price and the opportunity to force appreciation through improvements creates compelling total returns. I want to spend some time talking about the concept of housing as a hedge against inflation, because this aspect gets insufficient attention. Throughout my lifetime, I have witnessed numerous inflationary episodes. The 1970s were particularly challenging, with double-digit inflation eroding purchasing power rapidly. More recently, the post-pandemic period brought the highest inflation in 4 decades. Real estate performs well during inflation for several reasons. First, replacement cost rises with inflation. When construction materials, labor, and land all cost more, new homes must be priced higher. That higher replacement cost provides a floor for existing home values. Nobody will pay more for a used home than they would pay for an equivalent new one, but they also will not pay much less if the used home is comparable. Second, rents rise with inflation. Landlords adjust rents to maintain real returns on their investment. Those higher rents support higher property values through the income capitalization approach to valuation. An apartment building that generates more rental income is worth more, all else being equal. Third, mortgage debt becomes easier to service with inflation. If you borrow at a fixed rate and inflation pushes up your income over time, the real burden of your mortgage payments declines. You are paying back in cheaper dollars than you borrowed. This wealth transfer from lender to borrower is one of the great benefits of fixed-rate mortgage financing. During the high inflation of the 1970s, homeowners who had locked in fixed-rate mortgages at earlier, lower rates did extremely well. Their payments stayed constant while their incomes and home values rose with inflation. They built wealth rapidly, almost by accident.
Today, we are returning to more normal inflation levels after the post-pandemic spike. But inflation is not going away entirely.
The Federal Reserve targets 2% annual inflation, which compounds significantly over a 30-year mortgage term. A home that costs $400,000 today would cost over $700,000 in 30 years at just 2% annual inflation. Owning real estate with fixed-rate financing is one of the most reliable ways to protect yourself against that erosion of purchasing power. Your mortgage payment stays constant in nominal terms, while inflation pushes up your income, your rent, if you rent out the property, and the value of the asset itself. This is why I remain bullish on real estate despite current affordability challenges. The temporary headwind of high rates is counterbalanced by the permanent tailwind of inflation protection. Over a multi-decade holding period, that protection will likely prove more valuable than any rate differential. Let me also discuss the psychological aspects of real estate ownership that make it particularly valuable. One of the greatest enemies of investment success is the tendency to buy high and sell low. People get excited when prices are rising and fearful when prices are falling. They chase performance at peaks and capitulate near bottoms. This behavioral pattern destroys wealth reliably across all asset classes. Real estate provides natural protection against this self-destructive behavior. Unlike stocks, which can be sold with a phone call or mouse click, real estate takes months to transact. The friction of selling, including agent commissions, closing costs, moving expenses, and the simple hassle of showing a property, discourages impulsive decisions. Additionally, people feel an emotional attachment to their homes that they rarely feel for stock certificates. They have memories in those walls. They have invested sweat equity in improvements. They have built relationships with neighbors. That emotional connection makes them reluctant to sell even when financial logic might suggest otherwise. This stickiness is actually a feature, not a bug. It forces people to hold through market cycles rather than selling at bottoms. It transforms impatient investors into patient ones almost automatically. It converts short-term thinkers into long-term holders through sheer inertia. I have observed this phenomenon throughout my career. The people who build the most wealth in real estate are often not the smartest or most sophisticated. They are simply the ones who bought something and held on to it for decades without touching it. Time and compound appreciation did the heavy lifting. This is yet another reason why I encourage people to buy real estate rather than waiting for perfect conditions. Once you own, inertia works in your favor. You become a long-term holder almost by default. And long-term holders in American real estate have done very well historically. Let me share some thoughts on how different types of real estate perform across market cycles. Single-family homes are the most accessible entry point for most investors. They offer the combination of personal utility, if you live in them, and investment returns. From appreciation and potential rental income, they are relatively easy to finance with government-backed mortgages. And they offer favorable tax treatment, including the mortgage interest deduction and capital gains exclusions for primary residences. In the current environment, single-family homes face affordability pressures but benefit from severe supply constraints. The number of existing homes for sale remains near historic lows because homeowners with low-rate mortgages are reluctant to sell. New construction has increased but remains below the level needed to satisfy demand. These dynamics support continued price appreciation in most markets even as transaction volumes remain subdued. Buyers who can qualify for financing at current rates are finding less competition and more negotiating leverage than they would in a lower rate environment. Multifamily properties, meaning apartment buildings of various sizes, offer different characteristics. They generate income from day one rather than requiring you to live there or find tenants for a single unit. They spread risk across multiple tenants rather than concentrating it in one occupant. And they often appreciate well because income growth drives value. The current environment for multifamily is mixed. Some markets have seen significant new construction that has temporarily elevated vacancy rates and depressed rent growth, but the long-term fundamentals remain positive. Rising home prices are pushing more households into renting. Demographic shifts favor apartment living in urban and suburban cores, and the inability of many households to save for down payments ensures a permanent renter population. For investors with the capital and expertise to acquire multifamily properties, this cycle presents opportunities to buy from stressed sellers who over-leveraged during the low-rate years and now struggle with refinancing at higher rates. Commercial real estate, including retail, office, and industrial properties, offers yet another profile. These properties are typically larger, more complex, and require more specialized expertise. They are also more sensitive to economic cycles and tenant-specific risks. In the current environment, different commercial sectors are performing very differently. Office faces structural challenges from remote work that may persist for years. Retail continues to be reshaped by e-commerce, though well-located properties in strong markets remain valuable. Industrial, particularly warehouses and distribution centers, has benefited enormously from e-commerce growth and supply chain restructuring. At Berkshire, we have exposure to various commercial real estate through our insurance float investments and direct holdings. We pay close attention to the specific characteristics of each property and market rather than making broad bets on commercial real estate as a category. For most individual investors, single-family homes and small multifamily properties offer the best entry points. These are accessible, financeable, and understandable. Larger commercial properties require expertise, capital, and risk tolerance that most households lack. I want to address another aspect of real estate that gets overlooked in rate discussions: the value of locking in housing costs. When you rent, your housing cost floats with the market. Landlords can and do raise rents annually to reflect increased property values, higher operating costs, and general inflation. A rent that seems manageable today may become burdensome in 5 or 10 years as increases compound. When you own with a fixed-rate mortgage, your principal and interest payment is locked for the life of the loan. Yes, property taxes and insurance can increase, but the largest component of your payment, the mortgage itself, stays constant. This difference compounds dramatically over time. Consider two identical households, one renting and one owning, with identical incomes and initial housing costs. If rents increase 3% annually and the owner's costs increase only 1% annually, reflecting tax and insurance hikes, the owner's advantage grows every year. After 10 years, the renter is paying significantly more than the owner. After 20 years, the gap is substantial. After 30 years, the renter might be paying double or triple what the owner pays for equivalent housing. Meanwhile, the owner is building equity with every payment while the renter accumulates nothing. This is the true wealth-building power of home ownership. It is not speculation on price appreciation, though that often occurs. It is the systematic conversion of housing expense into equity accumulation combined with long-term cost control. Many people focus on whether home prices will go up or down in the next year. That is the wrong question for most buyers. The right question is whether owning will reduce your total housing cost over the next 2 or 3 decades compared to renting. For most people in most markets, the answer is yes. Let me also talk about the role of real estate in retirement planning. One of the greatest financial challenges facing Americans is funding a potentially long retirement. People are living longer while traditional pensions have disappeared. Social Security provides a foundation, but not enough for comfortable living. Investment portfolios must carry more weight than ever before. Real estate plays several valuable roles in retirement planning. First, a paid-off home dramatically reduces required retirement income. If your mortgage is eliminated by retirement, your housing costs drop to just taxes, insurance, and maintenance. That lower expense requirement means you need less savings to fund your lifestyle. Second, home equity can be accessed in retirement through reverse mortgages, home equity lines of credit, or downsizing. That flexibility provides a financial cushion for unexpected expenses or supplemental income needs. Third, rental properties can provide steady income throughout retirement. A portfolio of paid-off rental properties generates cash flow regardless of what stock markets do. That income diversification reduces sequence of returns risk that threatens traditional investment-only strategies. Fourth, real estate offers an inflation-adjusted income stream that few other assets provide. As rents rise with inflation, rental income maintains its purchasing power. This is particularly valuable in long retirements where cumulative inflation can dramatically erode fixed income sources. For these reasons, I believe real estate deserves a meaningful allocation in most retirement plans, not to the exclusion of stocks and other assets, but as a complement that provides income, inflation protection, and diversification benefits. The current high-rate environment creates particular opportunities for pre-retirees to acquire properties that will generate income in their later years. Buying now, while prices reflect muted demand, positions investors for a potentially more valuable asset when they need income most. Now let me provide some additional guidance for navigating the current market. Understanding local conditions is essential. Real estate is famously local, and national statistics can mask enormous variation between markets. Some cities face severe supply shortages that support prices regardless of rate environment. Others have overbuilt and face supply gluts that pressure prices. Your investment thesis must reflect the specific dynamics of your target market. Generally speaking, markets with strong job growth, limited buildable land, and regulatory constraints on new construction offer the best long-term fundamentals. Coastal markets often share these characteristics, but some interior markets with technology or healthcare-driven economies also demonstrate strong fundamentals. Conversely, markets with abundant land, permissive zoning, and volatile local economies present higher risks. The Sun Belt has seen enormous new construction that has temporarily oversupplied some markets. While long-term demographics favor these regions, near-term price appreciation may be muted as excess inventory is absorbed. Do your homework on specific markets before investing. Understand population trends, job growth, new construction pipelines, and historical price patterns. A good property in the wrong market can underperform, while an average property in the right market may excel. Work with local experts who understand these dynamics. National brokerages and online platforms provide convenience but may lack deep local knowledge. A local agent who has operated in a market for decades understands nuances that algorithms miss. Consider different property types based on your objectives. Primary residences offer utility plus appreciation. Rental properties offer income plus appreciation but require management. REITs offer diversification and liquidity but lack control and utility. Each serves different needs in different portfolios. And above all, take a long-term perspective. Real estate rewards patience. The investors who do best are those who buy good properties at reasonable prices and hold them for decades. Market timing creates stress and transaction costs without reliably improving returns. As I reflect on nearly 7 decades of investing, real estate stands out as one of the most reliable wealth-building tools available to American families. It provides shelter and stability while building equity. It offers inflation protection that few other assets match. It forces patience through transaction friction, and it compounds steadily over long holding periods. The current environment of high rates creates challenges but also opportunities. Those who can see past temporary headwinds to permanent tailwinds will position themselves for success. Those who wait for perfect conditions will likely wait forever. I remain optimistic about American real estate. The supply shortage is real and persistent. Demographics favor continued demand. Inflation protection becomes more valuable as central banks struggle to maintain price stability. And the 30-year mortgage remains one of the most favorable financial instruments ever created for individual wealth building. My advice is simple. If you find a good property at a price you can afford with payments you can handle, buy it. Date the rate. Marry the house. Let time work its magic. That is what I would do in your position. That is what I am doing through Berkshire's investments in home builders and related sectors. And that is what I believe will prove wise in the years and decades ahead. The opportunity is in front of you. The principles are timeless. The execution is up to you. Go build your future, one property at a time. Before I close, I want to address a few more questions that I frequently receive about real estate investing. Many people ask about the role of location in determining investment success. I have touched on this earlier, but let me elaborate. Location is perhaps the single most important factor in real estate success. You have likely heard the old adage that the three most important factors in real estate are location, location, and location. There is profound truth in that cliche. A beautiful home in a declining neighborhood will struggle to appreciate. A modest home in a thriving area will likely do well regardless of its shortcomings. The neighborhood determines who will want to live there, what they will pay, and how values will trend over time. When evaluating location, I look at several factors. Employment opportunities matter enormously. Areas with diverse, growing job bases attract new residents and support property values. Areas dependent on a single employer or industry face risks when that employer struggles or that industry declines. School quality matters for family, neighborhoods, properties. In top school districts, command premiums that persist across market cycles. Parents will pay more and accept longer commutes to get their children into good schools. This dynamic supports prices even when broader markets struggle. Infrastructure and amenities matter. Proximity to transportation, shopping, healthcare, and recreation increases convenience and desirability. Properties that require long drives for basic needs are less attractive than those where services are readily accessible. Safety matters. Crime statistics directly affect desirability and values. Neighborhoods that are perceived as unsafe struggle to attract buyers and renters regardless of other characteristics. Future development plans matter. Understanding what is planned for an area helps anticipate how it will evolve. A new transit line or major employer can transform neighborhoods. A planned landfill or industrial development can undermine values. I recommend spending considerable time understanding these factors before purchasing any property. Drive through neighborhoods at different times of day and night. Talk to residents and local business owners. Research historical crime data and school performance. Understand what is planned for the area over the coming years. This research takes time but pays enormous dividends. A well-located property provides a margin of safety that poorly located properties lack. Even if you make other mistakes, good location tends to bail you out over long holding periods. Another question I receive concerns timing, seasonal patterns in real estate. Should buyers wait for traditionally slow seasons to get better deals? Real estate does exhibit seasonal patterns in most markets. Spring typically brings the highest activity as families try to move before the school year begins. Summer continues strong activity before tapering in fall. Winter is typically the slowest season in most areas. These patterns create some opportunities. Sellers who list in winter are often more motivated. Competition is reduced as casual buyers wait for spring. Negotiating leverage may improve during slow seasons. However, I caution against over-optimizing on seasonal patterns. The savings from buying in December versus April are typically modest compared to other factors, and winter listings in most areas are fewer, reducing your selection. If you find the right property in spring at a fair price, buy it. Do not wait 6 months hoping for a better deal in winter. The specific property matters more than the season. Homes sell individually, not as a category, and good properties attract buyers regardless of timing. I also receive questions about whether to buy fixer-uppers or move-in-ready homes. This depends heavily on your skills, time, and risk tolerance. Fixer-uppers offer the potential for forced appreciation by purchasing below market and adding value through improvements. They can also be purchased with less competition since many buyers prefer turnkey homes. However, fixer-uppers carry real risks. Renovation costs routinely exceed initial estimates. Timelines stretch longer than planned. Hidden problems emerge during construction. Permits and inspections create delays and expenses. For investors with construction experience or contractor relationships, fixer-uppers can be excellent opportunities. They understand true costs and can manage projects efficiently. Their skill set becomes a competitive advantage. For investors without this experience, fixer-uppers can be money pits. They underestimate costs, mismanage contractors, and lose money that eating into appreciation potential. I generally recommend that first-time investors buy properties in good condition. The simplicity and predictability offset any potential savings from renovation. As you gain experience and develop contractor relationships, fixer-uppers become more viable. Another common question concerns financing strategies beyond traditional 30-year mortgages. Adjustable rate mortgages offer lower initial rates in exchange for rate variability later. They can make sense when you expect to sell or refinance within the fixed rate period. But they carry real risk if plans change and rates increase when your loan adjusts. 15-year mortgages offer lower rates and faster equity building in exchange for higher monthly payments. They make sense for borrowers who can comfortably afford the higher payment and want to eliminate debt faster. But they reduce flexibility compared to making extra payments on a 30-year loan. Interest-only loans reduce initial payments by deferring principal repayment. They can make sense for investors who prioritize cash flow, but they delay equity building and can create problems if property values decline. For most buyers, the 30-year fixed-rate mortgage remains the best choice. It maximizes flexibility, provides payment stability, and offers the refinancing optionality I described earlier. The slightly higher rate compared to shorter-term options is worth paying for these benefits. Let me also address the question of whether to pay off a mortgage early or invest extra funds elsewhere. This depends on your rate, risk tolerance, and alternative investment opportunities. If your mortgage rate is low, say 3 or 4% from the pandemic era, investing extra funds in diversified assets may generate higher returns over time. Stock market returns have historically exceeded those rates. If your mortgage rate is high, say 7% today, paying down the mortgage offers a guaranteed tax-adjusted return that is hard to match elsewhere with equivalent risk. The emotional component matters too. Some people sleep better with no debt regardless of the mathematical optimization. Others prefer maintaining mortgage leverage while building wealth elsewhere. There is no universally right answer. My general guidance is to prioritize paying off high-rate debt, then maximize tax-advantaged retirement accounts, then consider whether additional mortgage paydown or taxable investing makes more sense for your situation. One more question I want to address concerns the decision between buying and continuing to rent. Many financial commentators have created complex calculators to help with this decision. They model home price appreciation, rent increases, investment returns, tax benefits, and transaction costs to determine break-even periods. These tools can be helpful but often create false precision. Nobody knows future home price appreciation or stock market returns with confidence. The inputs that drive calculator outputs are largely guesses. My simpler framework focuses on 3 questions. First, will you stay for at least 5 years? Real estate transaction costs are substantial. Agent commissions, closing costs, and moving expenses easily reach 8 to 10% of home value. Recouping these costs requires several years of appreciation or rent savings. Short holding periods favor renting. Second, can you comfortably afford the payment? Notice I said comfortably, not barely. Housing costs that stretch your budget create stress and risk. They leave no room for unexpected expenses or income disruptions. A payment that feels manageable with cushion to spare is far superior to one that works only if everything goes right. Third, are you ready for the responsibilities of ownership? Homes require maintenance. Things break and need repair. Yards need attention. Homeowners associations make demands. Some people enjoy these responsibilities. Others find them burdensome. If you answer yes to all 3 questions, buying likely makes sense regardless of what calculators say. If you answer no to any of them, renting might be the better choice even if calculators favor buying. The non-financial benefits of ownership, stability, community connection, pride of ownership, ability to customize, often outweigh marginal financial differences between buying and renting. These softer factors deserve weight in your decision. I want to conclude with some thoughts on the future of American real estate. America remains the most dynamic and opportunity-rich economy in the world. Our population continues to grow through natural increase in immigration. Our innovation engine continues to create new industries and new wealth. Our institutions, despite challenges, remain more stable and trustworthy than most alternatives. These fundamentals support real estate values over long time horizons. Yes, there will be cycles. Prices will fluctuate. Some markets will outperform while others struggle. But the overall trajectory remains upward as it has for generations. The specific challenges of today, high rates, elevated prices, affordability concerns, are real but temporary. Rates will eventually normalize. Construction will eventually increase. Affordability will eventually improve through some combination of price adjustment, income growth, and rate relief. Those who invest during challenging periods often do best when conditions improve. The properties they buy at today's prices with today's negotiating leverage become more valuable as competition returns and prices rise. I have lived through many real estate cycles. The market crash of 1973 and 74, the savings and loan crisis of the late 1980s, the bubble and collapse of 2006 through 2009, the pandemic dislocation of 2020. Each time, those who held quality properties in good locations came through fine. Many prospered. This cycle will be no different. The opportunities that exist today will look prescient in retrospect. The fear that keeps buyers away will eventually dissipate. The market will recover, and those who position themselves wisely will benefit. I encourage you to think about real estate with that long-term perspective. Do not obsess about whether rates will be 6% or 7% next quarter. Do not try to time the exact bottom of any market correction. Do not wait for conditions that will never be perfect. Instead, identify properties that meet your needs at prices you can afford. Secure financing that fits your budget with room to spare. Plan to hold for many years or decades, and trust that the long arc of American real estate bends upward. That is my final message to you. Real estate has been a tremendous wealth-building tool for American families for generations. It will continue to be one for generations to come. The current environment of high rates creates short-term challenges, but also creates opportunities for those who can see beyond the immediate headlines. I am investing in real estate while rates are still high. Through Berkshire's homebuilder stakes, through our REIT holdings, through our Clayton Homes subsidiary, through our operating businesses that serve the housing sector. This positioning reflects my confidence in the long-term fundamentals of American real estate. You can position yourself similarly. Buy a home if you are ready, acquire rental properties if you have the skills and capital, invest in REITs if you prefer liquidity and diversification. Add real estate to your portfolio in whatever form makes sense for your situation. The opportunity is real. The time is now. And the future belongs to those who act. Thank you for listening to an old investor share his thoughts on a topic that has been central to American wealth building for centuries. Real estate is not glamorous. It is not exciting. It does not generate headlines the way technology stocks do, but it works. It has worked for me. It has worked for millions of American families. And it will work for you if you approach it with patience, discipline, and a long-term perspective. Date the rate, marry the house, build your future. That is what I believe. That is what I am doing. And that is what I encourage you to consider as you make your own investment decisions. The rest is up to you.